So you've got, if you were on yesterday's one, you're going to love this one as well. So let's kick off. You can see me in the corner down there. That's me waving. There you go. You can see me over there. So these are some of the things we're going to look at. Now, why have I got a picture of my wife and son? Well, other than the fact that they're beautiful, is because I'm answerable to them. I've got to make sure that when I pick stocks for their ISA and their SIPs, that I don't mess it up. And that's probably the best way of me addressing this webinar to you. I'm going to share with you my thought processes that I have for them, including all the data I look at. And these are some of the questions I'm going to answer. Well, which companies? Where are the opportunities? How much is there to gain? When should we get in? Should we still be waiting? What are the risks, of course? And how generally do you go about managing your pension yourself so you don't have to spend hours and hours? Now, I try and minimize it to 1 hour a year to pick the stocks and then monitor that portfolio a couple of minutes a week. Okay. Of course, I spend a lot more time on the markets just because I love it. That's what I do. You know, as an asset manager, it's what I do. But I'm talking about just managing the pension. So I think with my son's one, it doesn't even take an hour in a year. It probably takes about 30 minutes. And that's it. So we're going to look at that process for you as well. Like I said, just let me know you can all see and hear me. Put it into the chat box. Any questions you've got as we go along, ask me. And I can see Rob, Ash, Jeffrey. Let me know where you're from as well. I think that's always useful. Brian, Martin, Dimitar, Rakesh, Vic, Derek, Richard, Chris, Ian, Elaine, Tarek, Alfredo, Alex, Ravi, Yap. Hi, Yap. Paul, Prakash, and a whole bunch of others we've got on. Martin, Peter, David, Jules. Come on, I won't go through everybody. Okay, so let's get on with it. Where are we on this? And you should be able to see that screen loud and clear. First things first, this is not individual stock advice because I do not know your personal circumstances. Therefore, I could not say to you, oh, this is a stock you should buy, because for all I know, you're a 100-year-old widow, or, I don't know, you're a 20-something billionaire. So this is to give you an idea of what I own, what Warren Buffett owns, what George Soros owns, what Bill Gates owns, and the process, and what our thinking is about the markets at the moment, okay? So it also includes a stock market update. It's part of my campaign for $1million.com, which is to teach 1 million people how to be better investors. And we're going along well. I think we've got over 100,000 people who've enrolled, engaged in various online free materials that I've provided to improve their education, okay, on the market. So where are we? Well, the main problem is this. It's risk. As I said yesterday, yes, stocks are going up and people are worried about inflation and they're saying, yeah, well, you know, I need to up my returns because of inflation. But actually, the bigger danger is you end up taking unnecessary risk. And you see performances like this, but the problem is there's only one factor in this that we're looking at. That's momentum, which is how has it done in the last 6 months. That's not enough. It is a factor I think we should always look at, but it's one of several factors, and that's how I want you to analyze this. So yes, there are opportunities out there, and you might even own some of these stocks. Let me know if you do. Okay, Robert, UK now, previously in the US. Fantastic. So I've shown you the US on the right-hand side and, excuse me, the UK on the left-hand side. And how do we get some of these without having the risks associated with them? Okay, and such that we don't just look at momentum alone. Now, this is from Goldman Sachs Asset Management. And the reason I've replicated it from my books previously. I've replicated it in my Financial Times columns in the past as well, okay? And therefore, it's not particularly controversial. What it says is that if you're here, which is at retirement age, you've probably got about half your portfolio, or just under half, in equities. You might have as little as 20% in equities. If you're more risk-loving and independently wealthy, you might have as much as 60% almost in equities, and the rest in fixed income, for which read just cash, okay? And you can work out where you are on this, right? So that's the first thing I want to show you and I want you to be aware of. Right, you might not be entirely in this, but this is a good benchmark. Another good benchmark to use is how many stocks might you want in a portfolio. Now, if you've given your money to fund managers, and one's a China stocks fund manager, the other one's the US markets, another one's UK, excuse me, maybe 5 different fund managers, then the problem might be, I wonder if it's this tie, which is too tight. The problem might be that each one of those fund managers has bought maybe 100 stocks, 50 to 100 stocks, and therefore you've got 5 fund managers with 50 stocks. That's 250 stocks. Problem with that is it's not giving you any great advantage in terms of reward or mitigation of risk. The conventional wisdom is you should have somewhere between 15 to 40 stocks. By then, you've eliminated company-specific risk, and all you're left with is market risk. If you want to eliminate market risk, you don't buy more stocks, which is the mistake most people make. You put your money in a bank account. And this year, for the large part, I've ended up having to eliminate market risk because the market risk has been all downwards, and therefore I've ended up holding more cash. How did that come about? Was it because I had some great vision on January the 1st? No, not at all. On January the 1st, you're looking at the markets and there was some steep downward momentum. I thought, oh, I'll leave it another week before I deploy extra cash. And then another week went by and things weren't improving, so I'll leave it another week. And my existing holdings were either hitting their 12-month holding period, in which case I'd have to exit them, or they'd fallen from their peaks by between 10 to 25%, which were those various sell marks. If I'm risk averse, then 10%, I get out all or half of the position. And if I'm more risk loving, because the markets are buoyant, let's say last year, the year before that, then I might wait for a 25% drop. But the point is, that eventually led to a natural rebalancing, which was naturally ended up holding more cash. Fresh cash didn't get deployed, and sales of existing stocks didn't get redeployed. So it wasn't because I could see into the future. I had no idea this year would turn out like this at all. I was hoping it would turn out like last year and the last 10 years, but it hasn't. The markets fell. And that's a simple process by which to do that. And the benefit of that is if you've got 15 to 20 or 25 stocks, then it's manageable. If you've got 100 stocks, that's not a manageable process, what I just described. Okay, and I'll go over some of this later because I've given you quite a lot in a very short space of time. So what is stock selection? Well, I'm going to put this into 2 columns. What you can reasonably foresee and what you cannot control or foresee. What you can't control or foresee is war. Example, what's happening with Russia, OPEC decisions, presidential tweets, all of these might affect the market. What the Chinese Politburo might decide to do with Taiwan, all of these can affect the stock market. Company demand changes by more than 5%. Can you foresee that? You might say, oh, yeah, so in hindsight, I can foresee everything. By the way, in hindsight, I'm 100% always correct. I'm sure you are as well. I'm talking about ahead of time. Supply chain. And actually, to be honest, nothing is guaranteed, not even the future projections based on the past. So what can you reasonably foresee? And why are we looking at stock selection? Well, the companies you pick rather than a broad basket of good, bad, and ugly. You can foresee that if you try and cherry pick the companies and you're the one in charge of picking them, you know what you hold. Whereas if you give it to a fund manager, you don't know what you're going to get. Okay, it's going to be very much like a box of chocolates. You will not know what you're going to get. You might get some good, bad, and ugly ones. Equally, if you just buy an index, you might get some good, bad, and ugly. So this is really for the kind of person to whom this left-hand column appeals. You can foresee the profits of a company, historical and projections. There could be some deviation, but you get a pretty good idea of what the share price is and what you're paying for every dollar in profits that company makes. You can see what you're paying for every dollar of sales, or how much dividends you may well get. Of course, company could change its dividend policy, but you get a pretty good idea. Okay, you certainly get an idea of the volatility of a share's price. Now, again, that can change. Companies can lack volatility for years and years, and all of a sudden they fall off a cliff. Okay, you can foresee that a bank account is safe. Cash is safe as a general rule, and you can probably foresee cash flow as well. So there are certain things you can foresee, and the stock picker likes that idea. All right. And again, why should we bother with looking at stocks and managing our own SIP and ISA? Why shouldn't we just keep it all in a bank account or choose an index tracker? And I'll deal with why we shouldn't give it to a fund manager in a second. Well, if you're over here, you manage your own portfolio in a stock brokerage account, which is like opening a bank account, as many of you will know, or a SIP or an ISA. Well, you want to cherry pick good companies. You don't just want a basket of 500. You don't want an index tracker, which is a basket of potentially bad companies. And you might think, well, I don't want those 500 companies. I want more of my money in, for argument's sake, a Microsoft or an Amazon or an Apple or whatever else, a BP, whatever else. And I don't want so much of my money in airlines, for instance. So that's your view. You want to probably spend, I think, an hour a year selecting the stocks. So you need an efficient process, which is what I'll teach you in this webinar, because you don't want to be spending all your time looking at the markets, unless you're me and a total geek, and I'm assuming you're not. And probably 5 minutes a week, just keeping an eye on the portfolio as it stands. You want to have control in the sense that you want to be able to hold cash if the markets fall sharply, as they have this year. Now, you've not had to worry about that for the last 10 years. And you want to be in a position to be able to protect your own pension and not just have to rely on some fund manager or an index tracker, which might fall for a very long period of time. But you might choose an index tracker if you're happy to pick poor performing companies in a basket of stocks, or you want to spend no time at all. You just say, I'm going to have an index tracker. That's all I want. Don't want to spend any more time. And you don't mind being locked into zero or negative returns because you either think you can't do any better, or you just don't mind. You just say, I've got a very long-term view. In the end, it'll all work out fine, right? And when I say zero or negative returns, that's the Dow. And various periods where, for prolonged periods, it can fall. We're not used to this. We're used to being spoiled over the last decade, where it just keeps going up. And by the way, you'll notice that I've only gone as far as 1974. That's just up to 1974. Then after that, there have been periods where it's gone sideways and done nothing as well. Now, in this webinar, one of the things I'm going to do, everybody, is I'm also going to share with you the research out of Nobel Prize-winning economists, Eugene Fama, Daniel Kahneman, and Richard Thaler, all three individuals that I used to write about in my Financial Times columns and in my books. And I'm going to convert that into practical stocks that I like, stocks which fit what they've said. Okay. And one of the other reasons I don't happen to like fund managers is this: 39% of all new money committed to funds went to 10% of the funds with the best performance in the prior year. Despite evidence, this is a sure way to poor performance. Somebody got a Nobel Prize for working that out. Okay, not just that, but a lot of research and detail that goes within it. So we want to look at some of that Nobel Prize winning research because, well, guess what? If I can, within the course of this webinar, give you little snippets of it, you don't need a PhD, you don't need to have gone to Oxford University, but you'll be able to use that information to improve your portfolio. Wouldn't that be a good thing? And that's what we're going to look at. I found this image, which I have to share with you. See that lady sitting there? She's sitting around $100 million. That's what $100 million would look like. Okay, true to scale, depending on how tall she is, but that, you know, that's the size what $100 million would look like. I just had to share this with you. This is the US debt. Okay, that's US debt. You can see there. By the way, see that little line I've just drawn? That's her over here. That's her. I'm not sure if you can see that, actually. There we go. That's her over there. Right? That's what it looks like. Am I making some statement about inflation? Not really, because I could have shown this diagram, and I have done 10 years ago. But that pile was half as large 10 years ago, and 20 years ago, when it was about 60%, 40% of what it is now. Okay? We'll come back to that, but I just had to share this because I found it today and I thought, oh, this is a good one to share with people. It's fascinating. Now, the big question you've all got, this was what typical 12-month performance looked like for us. Last year, year before, because the markets had been good. We'd had a tailwind. It wasn't because we've become suddenly stupid this year, but that's how it looked. And the processes I'm going to teach you is what generated these names. And Crocs did particularly well. Had I known Crocs was going to generate a 208% return, I would have put all my money in Crocs and nothing else, of course, which is why even a Warren Buffett diversifies, because if he was so good that he could see purely into the future and know the one stock which is going to go up 200%, he'd put all his money in just that company. Okay, so is it even possible to get this at the moment? Well, it's certainly going to be a lot more difficult. And it might even entail, as it has done, I think, for the first half of this year, holding cash and just waiting and waiting, a bit like a cricketer, just waiting at the crease and then having a slower start to getting his century. And 54% was a particularly good 12 months. It was from November 2020 to 2021. I think the October performance was about 45% if you looked at 12 months to October. So each month we look at our approved filtered list of stocks and we say, if we bought all of those and held them for 12 months, this is the return. And that's what we do. Now, can we do that again? Can we keep applying that process? now, and in 12 months from now, have another 54% return. Well, I can't tell you, as I showed you in earlier charts, I can't guarantee that, of course, because I can't guarantee, I don't know, President Putin might launch nuclear weapons tomorrow and wipe out the earth. Then nobody will know if I was right or wrong anyway. But one thing I can do is still use the same process, because we know the process, based on the valuation of a company, revenue growth, all those things that we can control, tends to, according to the Nobel Prize winning research and research from academics, tends to be correlated to share price performance. We know growing profits tend to be better than companies which aren't growing profits as a general rule. Good valuation and those share prices low compared to the profits a company earns, or cash flow or sales, tend to be correlated to better share price performance. So let's focus on those things. Not everything. If you want to gamble and throw the dice at some loss-making company on the brink of bankruptcy, it may well go up 200% tomorrow morning if there's a takeover bid from a wealthy Saudi businessman, for instance. But I'm talking about, let's stick to high probabilities. Okay, so what is that process? Now, before I turn to that process and share some of the names, the outputs of that process, I'm going to teach you how to fish, and then I'm going to give you some fish. One of the things that you're going to want to know is this. Take a picture of this if you wish. This I got from a newspaper. So it's not bang up to date, but it goes through, depending on the size of your pension, just some of the big providers of online pension brokerage services. So it could be a SIP or an ISA. You might open it with a Hargreaves Lansdown Interactive Investor, Saga, whoever. Okay, and these are the fees annually you might end up paying. I'm not endorsing any of these. I don't know any of these, other than the fact that I know they're all FCA regulated. So your money should be segregated and safe. Okay, that's the one thing I can say. None of them are charlatans, as far as I'm aware. So that being the case, so just keep that, take a picture of it on your phones or whatever. So let's go on with this other issue of, well, wait a minute, it's all well and good, but shouldn't we just give our money to a fund manager? No, this is an article from the FT, and that was 11 years ago. And there've been many before and many since about the underperformance of fund managers. So you're left with doing it yourself or an index tracker. Okay. So index tracker I've sort of dealt with. This is really a webinar for people who want to be more in control of their pension, don't want to spend too much time on it, but or pension or savings or whatever. You might be in your 20s. You might think, pension? What the hell's that? I'm just about savings. And don't forget, if you might be a pilot with British Airways. Well, guess what? Your money from your salary goes into a pension pot, which goes to fund managers who invest it in the stock market. So I've got news for you. It all ends up in the stock market. Okay, people who are thinking that, oh no, my pension goes, I'm an NHS nurse, my pension goes into some magic fairyland where magically I get given more money in some kind of, when I retire, in a Ponzi scheme of new people having come into the scheme who will pay for my pension. Nope, it doesn't work like that. It goes into the stock market. Okay, equally, you might say, well, I've given it to an IFA, I've given it to a financial advisor, and where I come in is to say to you, well, that's all well and good. Let's look at what they've put it in. These are the stocks through the funds that they've put it in. And do you realize you've got 500 stocks because of these funds? And what a lot of these big entities do is, because their job is to collect as much money as possible, obviously, because they get paid fees based on how much money they're managing. And then what they'll do is divide it amongst 5 or 6 different fund managers, and they'll just auto trade. The fund manager will say, right, buy for everybody, depending on how much money they've given us, a proportion of Microsoft, a proportion of Amazon, and so on. Well, it's not bespoke. And so really this webinar is for somebody who wants to create their own portfolio of 15 to 20 stocks, hold them for 12 months, and then redo the exercise, because they want to know what they own. They don't just want to say to somebody, oh yeah, you pick and choose it, you churn it, you charge me fees for doing something I feel confident being able to do myself. Okay? So again, where does that leave us? Well, I won't go into too much of this, but like I said, already what fund managers do is they'll divide your money by geography and by style. So it might be Japanese growth. Well, the problem with that is that they've got a narrow gene pool of stocks to pick from. What we're going to do instead is pick from a large gene pool, 10,000 stocks. Imagine you're interviewing people, and that's what companies are. You're interviewing them for your portfolio. Well, surely you want to interview as many CVs as possible. And this is where we're looking at 10,000 odd companies. Look at this. Okay, so I'm going to go through this, and I want as many greens as possible. And then I'll narrow that down, just like I would in an interview process. Now, I'm not going to narrow it based on, I think energy might do well. I think China might do well. That's gambling. No, I need to look at the three things all companies have. Their profit and loss accounts. Are they profitable? Are they growing in profits? What's their revenues like? What's their share price like? Their cash flow statement, can they generate cash? Because we know that's linked to share price performance. And finally, their balance sheet. What are the assets like? Are they able to convert those assets into profits and cash? Because we know that is linked to share price performance. Nothing's guaranteed. There isn't 100% guarantee of anything. Okay, but we know that given enough time, that certain things lead to share prices moving up rather than down. Now, this shouldn't come as a surprise to you. A company with no customers, making no profits and no sales is not going to do as well in its share price as one which is growing year on year, is it? Now, that's common sense. So we've got to just try and work out and differentiate which ones are in which, and keep our criteria so stringent that we get down to 25 odd companies that we like the look of. Okay, and I'm also going to, in this webinar, go through and give you the best bits of this stuff. So you can see there's a Goldman Sachs mid-year report, 22 report. There's Goldman Sachs 30 stocks to benefit from high inflation. I'll cover all of this stuff and give you the best of the best. JP Asset Management Guide to Market, second quarter 2022, Goldman Sachs 2022 outlook. You might say, well, I don't care about those people. They're idiots. They don't know anything, Alpesh. Well, that's fine. We're not going to, just because they've said buy something, we're not going to buy it. That's not our criteria. Our criteria, as I said, is based on valuation, profitability, revenue growth, i.e. sales growth, volatility, cash flow generation, those things to do with the accounts. If it just so happens that every single one of these major banks and every hedge fund happened to mention the same stock that we found as well, surely that counts for something. So we're going to look to see if the facts come up. And this is going to be our due diligence checklist. Now, before you get scared, 1 hour a year minimum is what you need to spend. Some of you will want to learn more about these and do a PhD on it. That's fine. You can spend more time. Of the various measures of valuation of a company, which we know is relevant to how a company will perform, the two that from my research and the academic research that I've seen, everything from the Nobel Prize winners to regular academics, these two formula tend to be pretty good. In other words, if you've got those two, whilst the others aren't bad, nothing wrong with the others, discount cash flow, price to sales, price to book, you're really overlapping a lot and there's no need to overdo it. You know, you're good enough. Growth, sales growth, profit growth, cash flow growth. Income, well, guess what? Income's not as important as valuation and growth, but it carries about a 10% weight, and we'd want to look at dividends. Momentum, how's it performed in the recent past? That is actually important. Media noise, there is no discernible signal. You will say, whoa, wait a minute, Alpesh. Of course, there's exceptions to every rule, but there isn't sufficient exceptions to have a pattern to say, oh, I'll look at Twitter and Reddit and find it. There are exceptions when it might have sporadically happened, but those exceptions were not enough to make a rule out of it. And if you can't make a rule, you can't make a process. If you can't make a process, then it's useless because you can't replicate it. If you can't replicate it, then you're just a historian. Okay, statistics, distribution of returns. We want companies which, for instance, are not likely to drop 20% in 5 days because they'll scare the bejesus out of you. All right, put very simply. Similarly, with volatility, there is a correlation between lower volatility companies, i.e. the tortoise, outperforming over the long term the hare. So companies which make the news and have high volatility, they make the headlines because that's how news works. But the ones which perform the best over a 12-month period tend to be the ones which have got lower volatility. Why would that be so? Because big money, i.e. pension funds, like to invest in lower volatility for obvious reasons, let alone lower volatility companies tend to be more stable and predictable, and that's something which is good and people want. So it could be a self-fulfilling prophecy as well. Larger companies, you might say, oh, no, wait a minute, smaller companies outperform. Yes, but the volatility isn't there, and you're better off over the longer term having companies skewed more towards larger cap. And you go, oh, no, Alpesh, I heard that if I have a bunch of AIM stocks and I diversify and I do this, well, I'm afraid the data doesn't bear out the nonsense that some of the financial journalists speak. They just repeat old wives' tales. Or old Osman's tales, I guess you'd say now. Is there a correlation between certain analysts and stock price movements? In other words, do certain analysts keep on getting it right beyond what you might statistically put down as coincidence. Similarly, are there certain people who own shares, like a Warren Buffett or a George Soros or a Bill Ackman or a Bill Gates, which beyond coincidence alone goes to suggest that actually if they own it, we might want to take notice. So we look at all of these things, and that's my due diligence checklist. Hang on, Alpesh, if you've got 10,000 companies and you're cross-referring all of these across those criteria, my lord, you're just going to be working 24/7. Not really. Thankfully, they invented computers. Thank you very much, Mr. Babbage, for that. So how do we do it? Now, I'm going to go through that process, how we do it, so I don't have to bang my head on the desk. I don't like banging my head on the desk. Let's just have for a second, take a little detour. This is the hedge fund ownership report for the end of Q1 2022. So these were the figures released to the regulators by the end of March. On the left, you see the most popular stocks. Feel free to take a picture. Owned by hedge funds. And on the right, you see the top 25 healthcare stocks. Now, again, you'll be thrown names like this, as I am doing now, all day and all night on the internet, through magazines, Investors Chronicle, Shares Magazine, whatever, Investment Week, whatever. What do you do with such data? And I'm throwing at you right now. Equally, I might give you even more name. These are the top 25 materials companies, Chemours, Crown Holdings, Alcoa. What do you do with that information? I've just told you, the top 25 held stocks by hedge funds. So what do you do? Nothing? Something? What do we do when we get these names thrown out? Well, for me, the answer had always been, for a long time, looking at the academic research as to what should I do to simplify things. So, for instance, this is a piece of research. What has worked in investing? Studies of investment approaches and characteristics associated with exceptional returns. And I've been taking this approach since 1999. And I stole a formula from Goldman Sachs, which generates, and I'll share that with you in a moment, which generates their clients 30% per annum. Not guaranteed like a bank account every year, but over the long term, some years more than 30, some years less, averages out at 30% per annum. In the financial crisis, nobody got 30%, they got a negative return. But some years more, some years less, and averaged out at 30. So I'm going to steal their formula. It was actually invented by Deutsche Bank, and I'll share that with you in a moment. And that's the process I'm going to use to try and get my returns. I'll be some good years like last year where you can get a 54% return. This year's not. I'd be pretty shocked if I end up getting a 54% return this year. To be honest, this year I probably wouldn't be too disappointed with just a 10% return as things stand right now. Okay, so where are we on the, although with some of the energy stocks that may well be more than 10%, but we'll see. The year's not out yet. This is the S&P. Okay, this is the S&P, and I'm going to zoom in. And it goes to the S&P over the last 5 years. Let's just zoom into this. It has dropped 22% from peak to trough. It took 6 months in which to do it. So it pretty much peaked on the 1st of January of this year. And as of today, coming to the end of June, it is down 22.5%. Or thereabouts. It's actually a little bit less than that. Okay. Now, if it goes back and does a V-shaped recovery, and I'm not saying it will, I doubt it will revert back to that angle of inclination. It would give you a 25% return by pretty much the end of the year. 25%. Now, if you do a triple leverage exchange traded product, they exist, then you'd get you get 3 times that. You get 75% return by the end of the year. I don't think that's going to happen, and leverage is risky. Risk warning, don't do it. Okay. Well, why not double leverage up? Well, if it's not going to go up, so what do I think is actually going to happen, and how do I have to deal with things? Well, have we reached the bottom? I'll still have to wait and see. I'll wait another week, then see. And in a week, I might say, it's still foggy. Okay, but where are we? Well, we're in a better position in some ways than we were when the market had peaked, because obviously it's let off a lot of steam. So there's a lot more opportunities out there. What are those opportunities? Well, before I go into the specific stocks that I've bought, let me first of all take you through some of the more popular ones you've asked me to examine. This is Apple. Every time you see a B or a H, that means an investment bank has given it a buy or a hold for H, or even a sell recommendation. So let's zoom into Apple. Apple from its peak has dropped 25%. Were it to have a V-shaped recovery, then by the end of the year, you'd get a 32% return. Will it do that? I don't think it'll do that by the end of the year. What if it took 2 years? Well, I wouldn't mind a 32% return in a relatively safe company like Apple over 2 years. That's not too bad. Certainly beats inflation, doesn't it? Has it hit the bottom? I'm not quite sure. I do want to get back into Apple, but I'm not going to do it today. I might have to wait another week. Might end up waiting, as has transpired this year, even longer, but we'll see. And I'll make a analysis then. But my cash is still in my bank account for now. What about Microsoft then? Similar kind of analysis. It has dropped 30% from its peak. And were it to make a roughly V-shaped recovery, you'd get 35% return in about a year. Even if it took 2 years, I wouldn't mind. Certainly beats inflation. It's a big, sizable company. So do I buy now? Well, this is how you answer that question. If you're risk-loving, given it's a Microsoft, I wouldn't have a problem with you buying it now, all other things being equal, because I don't know your personal circumstances. Okay, but if you were like me, if you're risk-averse, you might say, well, I'm going to wait another week. Well, what do you determine that on? For me, what I determine it on is something that I've shown you over here. But you don't have to do all of this analysis. I tend to you can just look at my Telegram channel, which is free, and I'll tell you. That's still falling somewhat, the momentum, and you can see the momentum on the stochastic there. Stochastic down here. Now, what I've drawn is the weekly and the monthlies. So that's the MACD, weekly and monthlies. They're momentum indicators. They just think of it like missiles. That's falling down, down, down still. So we want to wait. We really want it to have bottomed and bounce up, a bit like a bouncy ball, right? Like here. Then you're more likely, when that happens, to have a bit more of a rally. It's not guaranteed by any means. It's not something you need to worry about. Normally, I'd expect you to even look at. But at the moment, given that I'm holding a lot of cash, I'm still waiting to see if that still falls a bit further. Okay, and that's what I'm doing. Similarly with Microsoft, I'm waiting. With Amazon, which again has dropped 44% since, I certainly hope you're not watching this on a cell phone, 44% from its peak in the last 7 months, and were it to do a V-shaped recovery, go back to where it started, then in the next year, you'd get a 65% return. If you did 2 times leveraged exchange traded product, which I've held in the past in Amazon and Microsoft and Apple, because they're big companies and relatively safe, then I'd get 130% return in a year. If that took 2 years, 130% I can live with. If it took 5 years, 130% return in 5 years I can live with as well. But the real question is, do you want to wait a week or not, Alpesh? At the moment, I'm still waiting. I'll wait another week. Okay, and it might end up being that I have to wait 2 weeks or 3 weeks, but I'm going to keep an eye on this, and you can follow me on Telegram and see how I get on with it. Meta, similar story, dropped 55%. That's got a potential 123% return. If you use 2 times leverage, then you'd be getting a 250% return. But don't use leverage. It is for sophisticated Formula One fighter jet pilots, Tom Cruise wannabes like me only. Don't use leverage. I'm just giving you some of the things that I do. Okay, so over 2 years, that could be, if it took 2 years for Meta to get back to where it was, that would be a 100% return. If it took 5 years, it's still doubling my money in 5 years, which when you look around at the markets at the moment, you'd think, actually, I don't mind doubling my money in 5 years. Okay, probably more than what my house will do. Right? COSTCO is another company I like. At some point, I will get in. It is sitting at a support. Is this the right moment? Could be, but I'll give it another week, I think, before I decide. And with that one, I'm fully expecting it to at some point go to its all-time highs again and give me a 34% return. I'm expecting that happen not by the end of the year, though. I think it might take a while, maybe a year. But today's not the day I'm buying it. Similarly with PayPal, I never expected this to fall as much as it did. What do you do when a company you think is fundamentally sound falls 77%? Well, you look at when you might want to get in again, and more likely than not, it probably has bottomed by now, because you look at these momentums and it looks like it's bottomed. That's what a bottom looks like in the world of charts. And of course, fundamentally, it's sound value, growth, income, and all the rest of it. So in 2 years, do I get a 40% return or just shy of? I wouldn't mind that. I wouldn't mind that in a year. But yeah, I think it'll probably go at that angle of inclination, not the steep angle that it fell in. Equally, I don't think it'll fall further. And if you think I'm wrong and you think it's going to fall further, don't buy it. What if you're a total pessimist, like Michael Burry, the hedge fund manager who was in the film The Big Short and is the CEO of Cyan Asset Management and in the news because he is really bearish? Well, this is what he owns. And for disclosure, I'm going to be buying Ovintiv. That's me. Doesn't mean you've got to buy it. Okay. And there'll be a time when I will be buying Apple and I will be again buying Alphabet and Meta. Don't think I showed Alphabet earlier, did I? I missed that. All right. Equally, what does somebody like Warren Buffett own? That's what he happens to own. Doesn't mean you go out and do it. Either I do own, for full disclosure, Occidental Petroleum, and he put another $1 billion worth of stock in it. So why did Warren Buffett, who can see the markets as much as you can, we all get the same data, he watches the same news channels, why did he buy more Occidental Petroleum? Why did I? I didn't buy it because he did, but because it met my criteria of value, growth, income. And this is where the price is right now. It has dropped some, from this current levels, if it drops down to its longer term trend, it'll be down another 30% potentially, another 30% potentially. But I'm assuming that's not what Warren Buffett thinks will happen. Otherwise, why would he have bought it today? What he probably thinks is going to happen is it's going to go along this trajectory that I've drawn, which would give him probably a 37% return over the next 12 months. Now, I'd like that, but I'm willing to spread the difference and say, well, I might only get 20% over the next 12 months. And in this environment, 20% I'm happy with. Okay, and I think that's what he thinks. Now, why did I pick Occidental? Value, growth, income, all the factors that I mentioned. Was it because Warren Buffett had it? No, the fact that he had it was just that additional factor, and these are all the things that we analyze in our due diligence. So having done all of that, what's the bigger picture? And I'll mention some other stocks and the processes more so in a second. Well, this is the bigger picture if you're in category A. Category A is the person who's probably in their 20s. They're planning to invest over 15 years. With my help, they want to try and get some of these 20% returns. If they use leverage, they might get more. In a good year like last year, they might get a 40%. Okay, let's say you've got 10K. That's all they've got because they're in their 20s. And they've got a 401k or a Roth IRA. I need to look up my US jargon. My sister from Florida called me up and said, should I do a 401k or a Roth IRA? And I was like, oh, I better swat up again. SIP or ISA. You also plan to add, let's say, 500 a month. I know what you're thinking. Who are you kidding, Alpesh? That'll go into electricity bills. You should have 600K over 15 years. That's what it'll look like. That's pretty much what my son, who was born 4 years ago, his junior ISA looks like. It's slightly off that because the last 4 years have been phenomenally good in the market. So he's got a bit more. And at the moment, he holds a bunch of cash. Why does he hold a bunch of cash? Well, because the holdings that he had, they fell back 10% or 15% or 25% from the peaks. And so he had to sell them. So he had to sell some at 100% gain, some at 70% gain, some at 150% gain, some at 50% gain, because it'd been a good market, but they'd fallen back now. And he will deploy that cash at some stage, or rather I will for him, and get him going up and up here. So by the time he goes to university, the year before he goes to university, he should get, just basically from the passive investments alone on this, about 80,000 just in 1 year. It's not bad, even though he's only contributed, well, he's contributed bugger all. His father's contributed it all, the ungrateful so-and-so that he'll become. But he's contributed just that much. But he'll be getting 80 grand a year, which is a weight off my shoulders in any event at that time when I call him from the beach I'll be staying in the Maldives. Okay, let's say you've got more capital, you're in your 40s, 50s, 60s, assuming you plan to invest over 10 years. And let's say you do make 20%, not as a guarantee, because you can't, there's no guarantees. Some years you might make more, some years less, because, you know, you're going through the due diligence process of value, growth, income, looking at the projections I've shown you. Well, let's say, and in fact, I just do all the work for you anyway. Look, it's all there. It's all done for you. I mean, somebody said to me yesterday, I want to be left alone with all this. It's too much difficult to learn. I said, no. It's like the maths class. The answers are at the back, mate. Look, they're all there. I'm just giving you the bloody answers. Didn't you see me give you them? Let's say you've got 100K in a 401k SIP or ISA. You also plan to add 1.5 each month. Well, you'll have $1 million by the end of 10 years. What does that look like? That's what it looks like. And that's my job for my family. It's very simple. As a mentor of mine once said, his job for his family is to make the money. So my job for my family, pay the bills, make the money. Turn every 100,000 into $1 million, or every 10,000 into 100, and every 100 into $1 million. It takes time, and that's what happens. If we get a good run in the markets, you do it sooner. If we don't, it takes longer. Just like getting to New York from London. If there's headwinds, it'll take longer. If there's tailwinds, it'll take less time. Now, I'm going to give you a lot more information in this, but can I just start at the end of this, in the last 10 minutes, talk about not just my campaign for 1 million to teach 1 million people how to be better investors, but also some spin-out technology from my hedge fund, and also what we plan to do with it, get venture capital investment and then float it on the stock market. I'll do that in the last 10 minutes. Put yes in the box if you want me to. If you don't, then don't worry, you'll be ejected out before the last 10 minutes and you won't ever have to see it or hear about it ever again. So remember this due diligence checklist, okay? Valuation, PE, PEG, growth, sales, earnings, cash flow, income, dividends. These are the factors, remember, that I'm looking at. Now, how do we manage to save time in looking at these? Like I said, what we do is we'll look at value, growth, income, so valuation, PE, PEG, revenue growth. I put it all into a little algorithm to score it out of 10. So 7, 8s, 9s all get a green. Cash flow, I'll come to that in a second, which is this column here. Cash flow, momentum, which is that. Sortino, which is average performance versus the risk or volatility of missing it. Alpha, which is outperformance of the market. We all want to do that. And we've got volatility numbers here. The other numbers you can pretty much ignore for now. Well, wait a minute, Alpha, you didn't mention what those companies do. Well, once I've got a short list, if I really care and want to know what those companies do, I can read about it here in any event. The point is, I need greens in these first 6 columns. I want those all to be green. Okay, if they're not out of 10,000 companies, then they don't make my cut. In fact, I make the criteria tighter and tighter and tighter until I get to about just 100 odd companies to pick from. Okay, why would I keep criteria loose after all? What's the point of that? So, as Michael Bloomberg, the billionaire, once said to us when I used to have a TV show at Bloomberg for 3 years, and Tuesday nights, Wednesday nights, I'd do the show. I'd actually go on air anytime I wanted on those days when I was in the studios and talk about whatever I wanted to. As he once said, don't mess it up. And that's what it is. That's what my family's saying to me. Just don't mess it up. So what are the criteria that I use? Well, one of the secret sauce criteria that I use in selecting stocks, as I've said, value, growth, income, cash flow. What's the cash flow one? Well, this is the formula invented by Deutsche Bank. Don't worry, it looks ugly and complicated. You don't need to know it. I'm just giving you more information than you need because I think knowledge is divine. Cash flow over capital invested. It's called cash return on capital invested. And what Deutsche Bank and then Goldman Sachs Asset Management, and by the way, it's from Goldman Sachs Quantum Database, the Goldman Sachs Global Investment Research, and it's their wealth management business. And I stole the slide because they were presenting to me as a hedge fund manager. They wanted my business, so they present this and said, look, we can manage it for you. And I thought, thanks very much, I'll do it myself, and took it off them. So forgive me, Goldmans, if you're watching it. But Deutsche Bank, as I said, invented this. And what they discovered is that companies in the top quartile, the top 25% by Croakey, generated 30% per annum. 30%. Not every year. It's not a bank account. For instance, in the financial crisis, nobody did. They dropped about 40%. They had a 40% loss in 1 year. Yeah. But on average, those stocks, it's not the same stock. You don't have the same stock in 1999 all the way to 2010. It means every year, every 12 months, you pick the top quartile by Croakey, top quartile. That's why I say I hold for 12 months and then I redo the exercise. And on average, you got that. So if you pick the top quartile in 2007, despite using the same exercise, you had a 40% loss. But it's okay because you made it up as the year. It took you 2 years to make it up. Okay, I'm sorry. For those of you thinking that I can pick stocks which always go up every single year no matter what, you're wrong. Neither I, nor Goldman Sachs, nor the billionaires who are their clients, nor Deutsche Bank, nor anybody else can do that, which go up every single year. Sorry, nobody in human history has done that. However, what we know is that as a process, it's one that we want to adopt and incorporate into our own. So that's why it's one of the many things which is in there. Okay? And I use. And once we've got all greens in those columns, value, growth, income, cash flow, momentum, Sortino, alpha, volatility, PEG, then I may well come across names like I have here and energy stocks, most popular amongst hedge funds, and I'll just check it against that list, what I call my approved filtered list. And I found that there were only 2 names on there, Pioneer Natural Resources and Terra, which were also popular with hedge funds. Now, if I hadn't come across the hedge fund ownership list, I wouldn't have cared either way. So what then happens? Well, what then happens is I might look at that and say, oh, look, Pioneer Natural Resources is on my approved filtered list. And I'll say to my wife and son, I might buy you some of this because look, if it continues on that upward trend, then in the next 6 months, we might get a 33% return. There's no guarantees. There's no guarantees on that. And that's the diagram. And they might say to me, okay, my son might say, okay, daddy, but I think stock market going to go down, in which case I probably won't do it. He is 4 after all, although he just sounded like a banking analyst then. So that's one. And Terra Resources, similar kind of story. in the next 3 months could be up 46% if it continues at that. Very popular amongst the hedge funds, and also, more importantly, was on my approved filtered list. More importantly, that's more important to me than what hedge funds happen to own. So we do all of that. And then you might say, well, wait a minute, if you're doing all of that, what is there for us to do? Well, for you is, if I give you all this data, is you still might want to pick your individual ones that I then look over and say, yep, that's fine. Or no, that doesn't fit in with what you told me about your risk profile. Okay, remember, this is for somebody who wants to have more control and know where they stand, and not just give it to some fund manager and tell them to do it for them and charge them an arm and a leg for it. Healthcare stocks, Johnson & Johnson, Bristol Myers Squibb, AbbVie, and United Healthcare also made my approved filtered list. Of the material stocks, which are the top 25 most popular amongst hedge funds, none met my approved filtered list. Sorry, it could be that they're overvalued, that everything's already factored into the price, because you might say, oh, well, wait a minute, Albish, commodities, boom, you're so wrong. All those hedge funds are wrong. You're wrong. Everybody's wrong. I'm the only one who's right. You may well be right. Tech stocks, Johnson & Johnson right there was the only tech stock, even though Netflix is very popular amongst hedge fund managers, which made the approved filtered list. Okay, remember, that due diligence checklist is this. And those are the things I think one should look through. If you don't look through this, the fewer things you look at, i.e. the less information you have, the more you're gambling. It's a bit like crossing the road and saying, I'm not going to look right or left. I'm just going to cross it. Oh, look, I made it. I must be really good road crosser. No, it just means you were gambling and you got lucky. I want to remove the element of luck. So I put it all into a spreadsheet of 10,000, and that's an approach I suggest you do. So you have a large gene pool, you remain in control of your SIP and ISA, you pick your stock, hold them for 12 months. If it drops 25% from the peak, and you might say if you're risk averse, I'm going to show you something I give. If it drops 25% from the peak, but you might say, well, I'm more risk averse than that, Alpesh. Well, that's fine. I have a section called What Should I Do, Alpesh? So there's your cash. Now, if you're risk averse, you wait a month, or you might average in over the next 3 months. And when you're ready, you might get from the approved filtered listings with volatility under 20%. It's all done for you. The answers are there, like in a textbook. You just run it past me, and I say, yeah, that's fine. Okay. Put another way, if you're risk averse, you might sell 10 to 100%, depending on your risk appetite. If you're risk loving, you'll just hold it for the whole 12 months and wait for it to drop not 10% from the peak, but max 25% from the peak. Okay, if you really like the stock and you think it's fundamentally sound, as I do with PayPal, you might say, well, I'm not going to sell it. I'm just going to hold it. It's fine. But you don't want to have too many of those. Otherwise, you'll never refurbish your portfolio, as it were. I developed this whole approach, as I said, when I was at university. I wrote books about it, won competitions in the FT about it. Financial Times published it. I taught people who gone on to become fund managers. Naomi, her first job, she knew nothing about investment. She left university with a degree in English literature, came to work for me, stayed with me for 2 years, and then joined Newton, and now at Polar Capital runs about £1 billion in assets under management. I'm very proud of her. The reason I show this is, other than the fact that I'm really proud of being able to do that and help others in their careers, is this. Fund management or picking stocks can be taught to an English graduate. It can be taught to anybody. Okay, an English graduate was a part-time opera singer. It's not like brain surgery or Formula One race driving or weightlifting, which you probably need some genetic disposition. Okay, so we used to get a lot of people asking me, obviously, as you can imagine, you're in the FT, you're on Bloomberg TV, you're on BBC, you're on CNN, all the rest of it. You're getting a lot of people saying, can you just do this for me, including family? And I said, no, I haven't got time to manage your capital. As a hedge fund, we manage only institutional money, which means it's got to come from a pension fund, a sovereign wealth fund, or a family office, not individuals. It's just, well, first of all, it's the law, but also it's too small, piddly sums with individuals. Plus, I didn't like the fact that retail clients were being charged fees. So I thought, well, is there a way of doing this where you're not charging anybody any fees? You're not charging monthly, daily, weekly fees, but you're giving them the information. And more importantly, you're sitting on Zoom calls with them if they need to go through the stocks that you told them fit the criteria, and then they might say, well, what about this one, this one, this one, or I've shortened it to this list, or I also want to pick this, and then you can say, well, this doesn't fit what you've said, and here's the data on it. So you curate and handhold them so they can do it in as little as an hour in a year, or as some want to, you give them all the materials to learn about croquis and cash flow and price to book and pegs and everything else if they so wish. Some want to be fund managers, 50%, and 50% just want you to do it all for them. And give them the names, and then they place the orders with their own broker, whoever their broker is. So what we realized is we might have something here which disrupts a multi-trillion-dollar fund management industry. Because the fund management industry doesn't teach you anything, which is worrying, given that it's your pension that you've just given them. Fund management industry doesn't allow you to ever speak to them and have a call and say, look, I'm worried about the markets. What's happening? What are you owning? They send you a monthly newsletter written by some intern who's 12 years old. And so we wanted to remove all of those problems. Equally, just dumping people with some software and saying, go away and do it, or an online program, an online course. Well, that just says, go find it yourself. Do your own research. What the hell does that mean? No, what we discovered people actually wanted is they wanted the education, but they wanted the one-to-one Zoom calls, and they wanted the answers. Okay, which are the stocks then? So, for instance, with the S&P 500, that's what it looks like once it's filtered down. That's what it looks like unfiltered. Got it? That's how it works. And then you've got to work it out what's suitable for that individual based on their risk profile. They pick the stocks, and you say that fits what you've said you want to do based on the data and the education. That was the answer. And it's the same approach I use when I'm on TV. If you see me, it's the same approach when I'm talking about stocks. And the approach has been commended, and my work has been commended by some big names, BBC, Financial Times, Coutts, and so on. I thought, you know what? This makes sense to spin it out of the fund. Yep, I think you're on here. So we did videos and interviews with students to see how they got on. And we actually recorded the videos because we thought, you know what? A quote could be any actor or whatever. As you can see from these delicious looking people, none of them are male models or actors. I'm sure they won't mind me saying, with the exception of Yap, who's on this call. But the point is that we'd recorded the videos with them, and that's just some of the interviews. And thanks to the modern technology of Zoom, Skype, WhatsApp, and Telegram, you're able to keep in touch with people. So we really wanted to absolutely disrupt the approach. If you like the approach, then what I do at webinars, and what my plan is to get venture capital investment into this and float the company in years to come. We think it's $1 billion business in the making, but it'll be when it floats on the market. It won't be from you guys paying me $1 billion, obviously. Is I take groups, they're in for life, and there's no daily, weekly, monthly fees. We take groups of 10 at the various webinars, because I know then I've got timing and scheduling, and it's my baby, and I want my baby to work. Just as when Steve Jobs launches the iPhone, he goes on stage, or he used to when he was like, go on stage and say, this is my baby, this is what we've launched, it's my vision, my baby. And I want to leave a legacy before I leave this earth of saying, you know what, this is the way it should be done. So people can spend as little as an hour, but be on top of it and understand what they're doing, or spend hours and hours going through the materials, as well as the data. And we provide different pieces of software. Part of my job is to source free software for people if they want to learn more, as well as giving them the databases and which stocks I like and what I've picked and the analysis I've given here, and have one-to-one calls with them. And actually, in fact, dinners. I've got a dinner coming up in 10 days, I think it is, as well, and looking over their shoulder. So they've got both. Some people only do one call a year. Believe it or not, some people will only do one call a year. They get it, they do the call, that's it, job done. They buy the car with the profits and whatever. Others, they do more. They just like to be a whole part of it. And I'd say it's 50-50 how that's broken up. So they get all this data and information and education. Some don't want any of that. They just want the answers. They want the 1 hour call.